Inflation continues to be one of the main problems of the Brazilian economy. The CPI is running at 10%, almost 3 times above the central bank target. In this sense, the central bank is hiking interest rates, and our forecast is that the Selic rate will reach 11.5% by March next year. With such a high interest rate, we see the economic activity slowing down in the end of this year and particularly next year. We revised our GDP forecast for this year from 5 to 4.5 and for next year from 0.8 to 0. Another problem is on the fiscal front. The government approved a constitutional amendment that opened room for more expenditures next year, putting more doubts on the debt sustainability over time. In this scenario, inflation expectations and the exchange rate keeps under pressure, making the central bank task even more challenging.
The US economy and the world economy in general going into 2022 remains bullish. We continue to think that there's enough momentum going into 2022 to allow the US economy to grow way above potential. We think that 2022 growth in the United States will be a function of very strong consumption numbers and a very strong inventory buildup process that will take place over the whole year, because the level of inventories in the United States right now remains very low after the supply shocks that continue to affect the performance of the economy in 2021. Looking at inflation, we continue to be in the camp that believes that most of the inflationary problems in the United States are temporary in nature, and therefore they should mean revert relatively fast in 2022. We think that headline inflation will end at about 6% year over year 2021, and that it will fall to around 3.2% by year-end 2022. Our base case scenario assumes that rents go up, but for example, the price of used cars and new cars fall or stop increasing as they have always done, except during the pandemic, and therefore that we go back into some sort of normality. In terms of the Fed policy, we think that the Fed will increase the tapering velocity to 20 billion in January. It may increase it in February depending on the jobs number that we will be seeing in December and in January, but we still think that the Fed will take its time to increase interest rates. The market seems a bit more hawkish on this front. The difference in between our view and the market's view remains our expectation that inflation will fall faster than the market expects. Finally, in terms of the virus, we think that with the appearance of the Pfizer pill and the Merck pill, which is basically the Tamiflu for COVID, we do think that we're very close to the end of this tragic event tied to the COVID pandemic, and therefore 2022 will probably be a year which will look very normal compared to the prior 2 years. We think that 2022 is going to be a year in which China grows much less compared to 2021, but we're not in the camp that expects the Chinese rate of growth to fall below 5%. We still think that China will grow some 5.5% in 2022. We expect the authorities to continue to work on allowing for additional stimulus to take place come 2022. Obviously, we're going to see a major deceleration compared to 2021, which a year in which we expect Chinese growth actually reached 9%. So we'll probably get again 5.5% in 2022, but above the most expectations in the market now, which are below 5%. We do think that the actions that the Xi administration took against internet companies last year, plus the Evergrande debacle, have taken a toll on consumption, on confidence, and therefore growth has slowed down. But by the same token, we do think that come 2022, the authorities are going to be much more lenient in terms of the behavior and the management of companies. Plus, they're going to be very pragmatic in terms of trying to ensure that the property sector doesn't continue to see further headwinds, because the property sector continues to be a very important employment generator for China, and it's very important from a social standpoint and from social stability standpoint. So we do think that additional stimulus is coming. We do think that additional fiscal stimulus is coming, especially from the gubernatorial and the municipal fronts, and all those things will allow for growth to remain relatively high and for commodity prices to remain high, which is obviously very positive news for the LATAM region and the emerging region in general.
In the Eurozone, inflation hit a record high in November, with headline index surging to 4.9%. The harmonized index is being excessively affected by outside increases in energy prices, airfares, and the purchase of vehicles component. There are additional one-off factors that have pushed up inflation this year, such as the German VAT tax cut in mid-2020 and German carbon tax introduced in January 2021. These factors are currently exerting an upward effect on German inflation of 1.5 points or 0.4 points on Eurozone inflation, but they will drop out from the annual calculation in January. If supply shocks start to ease by mid-2022, which is our baseline scenario, we expect headline inflation to decline sharply next year, particularly in the second half, to below 2% by year-end. We continue to expect the ECB's pandemic emergency program to run its course until March of next year, while purchases under the APP program will likely increase from 20 to 40 billion euros per month to compensate for the expiration of the pandemic emergency program. While we had been expecting this decision to be announced at the December meeting, we think that the current deterioration of COVID-related indicators in the region and the uncertainty generated by the Omicron strain have increased the risk that the ECB may delay the announcement until February. Regardless, we think that the news that the net asset purchases will continue throughout all 2022 and will approximately match the planned amount of Eurozone government bond supply of around 500 billion euros next year. Yet, we think the ECB will keep open the possibility of renewing its pandemic emergency program beyond March, depending on the evolution of the current Omicron strain. In Chile, right-wing José Antonio Cast and left-wing Gabriel Boric move on to the presidential runoff on December 19th, following the general election last month. Although Cast secured a symbolic win, the race is far from defined. The result, coupled with the center-right and right bloc securing 50% or more Senate seats and just below half of those in the lower chamber, should be relatively positive for financial markets in the short run. However, regardless of who wins the second round, political uncertainty is likely to keep local markets under pressure throughout 2022. With the election behind us, legislators were no longer under pressure to approve the fourth pension withdrawal proposal. Indeed, the lower house rejected the plan, paving the way for the central bank to bring up its policy rate to a neutral level rather than a restrictive one at its December meeting. In light of the most recent economic activity data, which show an overheated economy coupled with inflation surging to 6% and a fast and substantial deterioration of the current account deficit, we continue to expect the central bank to hike its policy rate by 100 basis points this month. In Colombia, October inflation came in much lower than expected, increasing slightly from 4.5% in September to 4.6%, while the core measure actually fell from 2.3% to 2%. However, the downward surprise was mainly due to the VAT-free day and by a large decline in telecommunication tariffs due to increased competition and lower internet fares that kicked in October. However, price pressures have not dissipated and should show up more clearly in the November and December figures, with inflation finishing the year just above 5%. Moreover, third quarter GDP data confirmed the much faster than expected recovery of economic activity by posting a strong increase of 5.7% quarter over quarter, led by private consumption. These figures reinforce our view that the central bank will hike its policy rate by consecutive 50 basis points at its December, January, and March meetings, followed by a slower tightening pace until it reaches 5 to 5.25% next year. In Mexico, Banxico increased its policy rate from 4.75% to 5% at its November meeting in a 4-to-1 split decision. However, the minutes revealed that two board members have laid down the possibility of discussing a faster tightening pace as soon as in the upcoming meeting. At the same time, third quarter GDP was revised down to a 0.4% sequential decline. Banxico also lowered its 2021 GDP growth forecast from 6.2% to 5.4%, and now sees a downside risk on its GDP projections, while before they were seen as balanced. The fact that there were no votes for a 50 basis point hike in November shows that Banxico is in no rush to step up its tightening pace, especially considering that there are increased concerns about the inflation outlook. Therefore, we still expect a 25 basis point hike at the December meeting, but we acknowledge that a surprise 50 basis point hike cannot be ruled out. This risk may decline after the December meeting, given our impression that Banxico Governor nominee Victoria Rodriguez may bring in a less hawkish approach compared to that of outgoing Governor Díaz de León.